Tom Lee's Fundstrat is out with a new interview on Yahoo Finance today discussing our markets and what could be coming next. Here's what they had to say. After this interview is over, I will share with you something that Micron just said on their earnings call that has me second guessing basically everything.
It's important to know the S&P continues to be dominated by so many large cap tech stocks. So the broader market has not been doing as well as the S&P, but yet we're up 14.5% year to date. And so, a very nice uptrend. Tough to find any issue with that, except if you don't own any technology, then you've obviously performed much worse. A lot of reasons to be constructive about the market. We're heading into a very bullish time of seasonality in election years. July tends to be very, very good, similar to June. I think a lot of investors remain worried about geopolitical risk, about political risk, and the fear of growth slowdowns. But the bottom line is, technically, we have over 70% of all Russell 3000 stocks above their 200-day moving averages. That's actually a much healthier sign. So, yes, despite the minor breadth erosion we've seen in recent months, markets technically are still on very sound footing. And, typically during election years, they do tend to rise through about August, September before peaking and then selling off into the election. So I have no reason to say, without any evidence of trend deterioration, that can't continue. I'm actually still quite constructive. I think S&P gets up towards 5650 or so. First part of July tends to be very, very bullish. It's normally one of the best parts of election year, first couple weeks in July. So I think it's worth considering that May PCE might dip. That would cause a plunge in rates and the dollar, and actually stocks would rebound, and we'd see more of a broad-based rally, which we haven't seen in some time, and investors are anxiously looking for.
Very interesting. I want to dig into the breadth question a little more, because this has been so much a topic of debate lately. So this is a chart brought to us by Bloomberg, where they looked at the S&P 500 in blue. Then it's the percentage of stocks in the S&P above the 200-day moving average. That's in purple. And they've highlighted these areas where we've seen big gaps. Right now is one of those areas. So the S&P continues to rise, but it just shows the momentum is not there for many of the stocks within it. How much does that matter?
Well, it matters just that investors understand that it's happening. And it doesn't have to mean that the market is going to go into a correction or roll over. Those tech stocks can continue to go up, and the divergence can get wider and wider, similar to what we saw back in 2021. However, we can also see what I think is going to happen is as a start of the broader market to play catch-up. And we've seen a little bit of that in financials over the last week. We've seen it in healthcare with sectors like biotech breaking out. We've seen it in industrials. The Dow Jones Transports actually broke out of a very well-defined downtrend today. That gives me a little bit of optimism that investors are skittish. We don't quite see the ebullience and the complacency, but at the same time, the broader market is slowly but surely starting to show evidence that it's ready to start moving higher, which I do think happens in July.
So let's look at the S&P equal weight. This is the Invesco ETF that tracks that. And so are there also technical indications here that give you optimism that we're going to see a little bit of a breakout?
Well, not yet, no. Okay. The answer is, of course, no. But I mean, look, this is a well-defined triangle pattern. For those that look at technical analysis, anytime you see a huge run-up that then turns into a triangle, 9 times out of 10, you do get a continuation move, meaning we break to the upside. I happen to think that because I feel that rates are going to start to plummet along with the dollar, which is very counter trend right now in terms of a narrative. But I do sense that the data is going to continue to get weaker along the fringes. Inflation should start to fall like a rock. So despite the fact that gas and food prices are high for everybody, you have been seeing some evidence of broad-based inflation starting to come down. And I think that's going to be encouraging, not because a weak economy means stocks are good, more that the Fed's rate cut view will come back into line, and we'll have a little bit more clarity as to when they start cutting rates. But make no mistake, since March, look, it's been a tougher market if you don't own tech. The market's literally been sideways, very different than last October through March. So yes, we do need to see that evidence of broad-based movement. I think that happens in the next few weeks. I honestly am pretty optimistic we're going to see it turn back up.
We got to get in one more quick one, and then we got to send it to Micron here because we've got some earnings coming out. NVIDIA, because this is the chart that a lot of people are looking at here about whether we're going to continue to see upside for this one.
Look, it's technically and fundamentally very dominant right now. 3 days, it lost $300 billion in market cap, but you notice the S&P only lost about 1%. So it didn't really have the kind of extent of damage to the broader indices that many people thought might happen, because it is over 5% of the S&P.
Yeah.
I like NVIDIA. I own NVIDIA. I sent out a note to clients saying 115, 116 is really rock hard. Short-term support, if it gets under there, there's a long-term uptrend over the years. It hits right near 105. I think this company is going to continue to outperform. The Blackwell chips are going to be a big deal. Customers are still double and triple ordering. Technically, sure, it's overbought, but that doesn't mean you sell, and that's an important reason. We haven't seen any evidence of trend deterioration, and now we know that NVIDIA is being bought by XLK and other ETFs, and it's tough for me to avoid it. For many of you that know our product, Tom Lee, it's a super granny shot as part of his list.
Yeah.
And there's a lot of reasons to still embrace it. I think it goes from 118, where it is now, up to likely near 140 into the middle part of July, which would be a big move in a short period of time, so I like it.
Normally I don't post 2 videos in a 24-hour period, but when I seen this clip, I had to share it with you guys. That was a very powerful clip, and I want to just highlight some of the main points. Number 1, Mark Newton, the head of Fundstrat's technical strategy, says that the data will start to deteriorate around the edges, meaning not a total collapse, not a calamity, not a huge recession scare, but the data will incrementally continue to get worse, but most importantly, inflation will start to, quote, fall like a rock. And if you are bullish right now, you have to be under the assumption that inflation is going to fall like a rock, because that's how markets are priced. And you have to be under the assumption that the economy holds up to a certain degree. The second thing that Mark Newton said that I found very fascinating is he gave an outright prediction of where he thinks the S&P 500 could go in July, and that's closer to about 5650. Which would be upside from here in the S&P 500 of about 3.5%. Doesn't sound like a lot, but if we do get a broadening out of our markets as he expects, and it's not just big tech that's driving that next 3.5–4%, that could actually be a substantial move under the surface. And Mark Newton made it very clear that he expects over the next couple of weeks you will see a broadening out of our markets. And that's one of those things as well. If you are bullish right now, you have to be banking on a broadening out of our markets to carry stocks higher. Because let's all face it, there's no deals in big tech. NVIDIA's fully priced. Apple's fully priced. Google's fully priced. NVIDIA, Google, all of them, they're fully priced for perfection. Now, I'm sure we'll get perfection when we get earnings over the next couple of quarters. I have no doubts that those companies are going to go through with earnings. I think that would be the statistical highest probability outcome, but those stocks are even already priced for better than perfection. You have to see the markets that start to broaden out here. And there's really one way that markets broaden out, and that is inflation falling and the Fed can start to take a more dovish approach. Because in the last couple of weeks, I have grown nervous hearing Fed officials like Fed Bowman just a couple of days ago suggesting they may need to raise rates again. Like, some of these Fed officials are disconnected from reality, and they're sending signals to me that they're about to make a massive error. They're going to wait too long to start cutting rates. By then, we're going to be either in a recession or pretty close to one, and who cares how many cuts you get at that point? It's done, right? Markets are going to fall 20% at bare minimum. But if inflation indeed continues to fall like a rock and the economy does start to degrade around the edges, Fed Goolsbee said yesterday that he's actually watching initial jobless claims, and that could be a sign that maybe the Fed is too restrictive. Tomorrow, we get a new number for initial jobless claims, but here you can see there is an upward trend in initial jobless claims again after being flat from really September all the way until now. We're expecting that number tomorrow morning to come in 1,000 higher than last week, which would still be an uptrend of 239,000 initial jobless claims. Last week's number was 238,000, but it's really compelling when you take a look at the 4-week average for initial jobless claims. Here you can really start to see the rise. It seems like week after week after week, or 4 week after 4 week after 4 weeks. there is a noticeable increase. And tomorrow we will also get durable goods orders month over month. Some weakening around the edges would probably be that data coming in softer than expected. Last month we were at 0.7%. We're expecting positive 0.1%. That would be great. Anything that's really positive at all would be a good number. Slightly negative is not a terrible number because you're coming off of a really strong last month. But if you're super negative, then that's really going to draw up a lot of red flags about the economy and about the consumer. Friday is going to be your big data with core PCE that is expected to fall like a rock down to 0.1% month over month. You will also get personal spending data, and when the economy's GDP here in the US is over 70% based upon consumer spending money, that's a pretty important data point. And then lo and behold, the Grinch herself speaks Friday at noon, and that is Fed Bowman, that again suggested the Fed may need to raise rates again. And she just said that a couple of days ago. Now to the point I want to share with you guys in regards to what Micron just said. Micron is down about 7% in after hours. I think the stock overall was just priced for perfection. They were set up for disaster if they could not give us a Nvidia-like earnings. And that just did not happen. Guidance came in 200 million lower on the low side, 200 million on the higher side for Q4 revenues. EPS guidance came in 2 cents lower on the bottom side, about 15 cents higher on the higher side. Free cash flow missed by about 25%, coming in at about 2.4 billion. Wall Street was expecting about 3.3 billion. So it was definitely a sloppy report and rough around the edges. But this has me questioning everything I thought about AI GPU spend over the next 12 to 24 months. Micron says high bandwidth memory is sold out through 2025. This is the direct partnership that Micron and Nvidia struck earlier in this year, where Micron is now supplying Nvidia's DRAM and NAND. I don't really know how the enunciation of that, but that's kind of a crazy statement, because that would suggest that all Nvidia's GPUs are already sold throughout all of 2025. That's actually pretty insane. Micron also says the race for artificial general intelligence will drive significant growth for DRAM and NAND. For anyone that was worried about demand slowing down for GPUs, going through a little bit of an inventory glut and demand correction, if you will, because let's face it, Nvidia has pulled forward a lot of demand in a short amount of time, and there's questions out there how long that can hold up. And based on what Micron just said, that's saying essentially Nvidia's demand should hold up throughout all of 2025. And Nvidia is such an important aspect of our markets. You cannot have a bad quarter from Nvidia and get away from it scot-free in our markets. And this statement from Micron suggests that that's, well, what could happen? We could just not have a bad quarter for the next 4 or 8 quarters. Now to Mark Newton's point, in which he mentioned during that interview, the first 2 weeks of July are seasonally the best 2 weeks of any year. Going back to 1928, the 2-week return for the first and second week of July is almost 2.5% in 2 weeks. That's insane on a historical basis. The next closest week is the Santa Claus rally, the second half of December, which is what you typically think of as the strongest period of the year. And Goldman Sachs is out telling people to get their popcorn ready because they're expecting a similar rally as well. So here's the bottom line. We do have a lot of data coming out in the next couple of days. The markets are really watching out for the economy. We want to see, is it weakening too much? Recessionary style weakening, or just weakening around the edges, giving the Fed a reason to start cutting rates. Tomorrow's, well, Friday's PCE report is going to be massively important. That spending data is going to be very important as well. But as long as inflation continues to fall, plummet, as Mark Newton said, maybe even negative on your month-over-month core PCE, then the Fed can really start to look at cutting rates. If the Fed cuts rates soon enough, by the end of July, the next Fed meeting, we may actually avoid a hard landing, and stocks can start to broaden out from here. And the Fed funds futures markets really dictate what the Fed does ultimately. So the markets will react more based on the data than what the Fed even says. And you can track this using the Fed Fund Rate Monitor tool from investing.com. There is currently a 10.3% chance of a cut coming July 31st. If that PC data comes out good on Friday, if spending comes in weak, if you do see initial jobless claims rise tomorrow, I would argue the odds could jump to about 25 to 35% odds of a cut July 31st. If we get that next inflation report July 11th that comes in good as well, you may actually start to price in a cut July 31st, and that's where you get a big broadening out of our markets. Let me know what you think about this information down below in the comment section. Boss man over there is teething, so we're gonna go deal with that, get him a popsicle or something. I mean, after all, we're wearing the Christmas suit in July. Why not have a popsicle or some ice cream? It is pretty toasty outside too. It has been recently this year, huh? You guys have a fantastic rest of your day. If you were listening to my voice, if you made it to the end of this video, hit that like button as well as subscribe to the channel, and let me know your thoughts down below in the comment section. Where are you positioning in our markets? What stocks are you buying? Let us know. Don't save that to yourself. Let everyone know so we can make money as well. Thank you for watching. You guys have a fantastic rest of your day, and I will see you in the next one.